Hey guys, Courtney Epps here, and I'm so excited to share with you some questions that have been posted over the last week and help provide you with some answers and also allow you to have some access to some different strategies. And, a couple of these strategies I talk about a lot, but they're so powerful for you. And I want to make sure, sometimes we get so busy in life that we completely forget that we need to take care of some bookkeeping and or that we need to make sure that we have set up an LLC, set up an S corp election, all those things. So we'll be going into those, and I want to make sure you guys understand we are in the process of rebuilding an entire membership. I'm so excited about it. A couple of different videos that we've actually delivered in the last week, we're going to be posting here over the next couple of days so that you can have more and more access to ways to help you keep more of your hard-earned money. So a couple questions. Let's see. We've got, I love a breakdown that shows when you're starting a new business, these are the things. And guys, there's a couple things I will share with you. Obviously, there's lots involved if you are starting a brick and mortar business. If you're starting a network marketing business or a home-based business, it's nowhere near as much. But, a handful of things I would suggest, regardless of how big you are, how small you are, how much money you're bringing in, that you get an LLC. And that LLC is going to limit your liability, and it's going to allow you to take advantage of some tax deductions along the way. And if you just go ahead and get it done before you start making money, then you have nothing to worry about. So years from now, if you come back to me and say, Courtney, I really wish I would have had that LLC so I could have treated that LLC as an S corporation to save money in taxes, then I would have said to you, hey, because you did have the LLC years ago, now we can go back and actually treat that LLC as an S corporation. So we tend to find tens of thousands of dollars every single day that people are overpaying because of that one thing. The last conversation I just had today doing a tax strategy session was $99,000 that the person was overpaying every year by not having an LLC treated as an S corporation. So first and foremost, getting an LLC. Then when you're making more than $1,000 a month in gross income or net income after expenses, you need to go ahead and get an S corp election. Those are two key things. Setting up a set of books, having some sort of accounting software is crucial, guys, not only for running your business, assuring that you're audit compliant, making sure that you're saving as much money in taxes, and being able to provide you with tax strategy. There's no way possible for us to help you if you are not keeping track of your accounting on a monthly basis, quarterly basis, however you want to do that. But you need to have some sort of accounting software. So those are just kind of my tips, like LLC, S corp election, having that in place to have some sort of software. If you have a retail store, you have to get a retail license. There's lots of things that you have to do if you are a business owner that is not involved in the network marketing space. But if you're in the network marketing space, guess what? You don't. There's not a lot that you have to do. You just have to get it, sign up, buy the product, start sharing that information with people. And by doing so, you now can take advantage of the tax deductions. That being said, I want to discuss that while we're on it. I do not want you to think that for 1 second I'm saying that you need to sign up in a business and that it's just by signing up in the business and not telling anybody about your product and buying the product every single month that you have access to tax advantages. That's not what I'm saying. What I'm saying is you have to do daily business building activities. You have to spend 45 minutes a week, 3 to 5 days a week, attempting to do daily business building activities, meaning that you are sharing with people what you're doing, whether that be your product, your service, or your opportunity is irrelevant. The fact is that you need to be doing that. Now, let me think of anything that you need to do as far as owning a business. Now, handful of things. If you are starting to make substantial income, you need to hire your spouse so you can take advantage of fringe benefits. And we'll go into fringe benefits on another, conversation. But, you can hire your spouse. I would pay them a limited amount of money, like $100 a month. You can hire your kids and you can pay them $12,000 a year. So there's lots of things you can do. But in the beginning, it's all about setting up, having software. It's, and I want to write these down so I can actually, I'm going to make a video of it later, but having the software, making sure that you have your correct structure in place, an LLC treated as an S corporation if you're making money. The one thing I do want to caution you for, though, is anything that involves real estate, you don't need an S corp election to save money in self-employment taxes, because there is no self-employment taxes on rental income. So I want you guys to understand that. I fail to tell people that regularly, and I just want to make sure that you understand that rental income is not considered ordinary income, and you don't have to pay self-employment taxes on that. So there would be, if you're renting out a property, doing something like Airbnb, you don't have to do that. Okay. All right. So LLC, S corp software, and then making sure that you have any sort of business license. That would be one thing that most network marketing businesses, you don't have to have any sort of business license. You could definitely check with your state, but it typically trickles down to your county. And then if you're in city limits, you could just ask them if there's a business license for a home-based business owner. But typically that's not even something that you have to worry about. Being in network marketing, they have taken care of all of that for you, so you don't have to worry about it. Now, next question. Also, what point would you recommend incorporating? Well, I've already explained that. $12,000 a year or $1,000 a month in net income. And guys, if you don't know what I mean by net income, what I mean is that you make $1,000 a month in gross income. Let's say the company, or that's what you make. That's what your customers pay you, is $1,000 a month. Then you have expenses from that, and that leaves you with, sorry, I couldn't swallow for a second there. That was crazy. That leaves you with a net income. So what's left over is your take home in essence. So that net income number is what you want to treat. Once you hit $1,000 a month in net income, then you want to have an S corporation. I hope that makes sense. Now, my husband made a CARES Act withdrawal from his 401k, and we're wondering why they withheld $10,000 in federal taxes. But they've withheld the $10,000 in federal taxes because you still have to pay federal and state taxes on that money. And they withhold 10% to keep you from having to pay in so much when tax time comes. So maybe there's some confusion here, but if you took out $100,000, and I'm not sure, I'm assuming maybe that's what they took out, was $100,000, and they're going to take out at least 10%, and they withhold that for your federal tax return, so that in essence, you're, just like your W-2 income, they're withholding some of that, and it's going to federal and state taxes. You still have to pay the federal and the state taxes. You're just not getting hit with the 10% withdrawal penalty. So if you took that money out, know that, depending on how much money you took out, you're going to get hit really hard with taxes, because what happens is when you take money out of your 401k, you have to pay taxes on all of that. And not only are you paying taxes on the money that you made throughout the year, but you're also paying taxes on the money that you received from the 401k, and that could potentially put you in a higher tax bracket. So guys, my thought process on that, I would tell you, is that don't ever take money out of a 401k unless that there's no other option. One, this year is a good year to take money out, obviously, because the 10% penalty is taken away. But you need to be smart about it. Like, you can't just take money out of a 401k and not think about the consequences that you're going to get hit with. I've had people end up paying more than 50% of every dollar that they put inside their 401k, or that they took out, because they didn't plan on when they were taking the money out. If you were going to take it out, and I know this year is a different year because of the withdrawal penalty, but if you needed, $50,000 over the next 6 months, then I would take some out now and I would take some out in January of 2021. So I would not take all that money out right now, because you're going to get penalized, because it's going to force you to be in a higher tax bracket typically. So there's that. So we did that. How to set up an LLC and write off your car as a business expense. Well, setting up an LLC, a couple of things that have to happen. You have to go get a federal ID number from the IRS, from irs.gov. And then you have to go to the Secretary of State and fill out the paperwork that they require to be a domestic LLC is what you would typically be. If you decided to get an LLC in a different state, which typically doesn't work out, there's no real purpose in doing that. Even if you are treating it as an S corporation, so many people believe that wherever their S corp or their LLC is done, that they're going to save money in taxes. Well, that's not the case. All it's doing is forcing you to file another state tax return if that's required in that state, because the income flows to you personally. So it's not like you're not moving, you're not shifting the income off. Now, if you had a C corporation, which I don't suggest, and nobody in this group would even have a C corporation or need a C corporation for that matter, then you could potentially shift some income depending on what state you're in. But to set up an LLC, you first have to go to, guys, I'm going to go get some water. I'll be right back. Okay, I'm back. I know that was crazy. I'm sorry. Anyway, so the LLC, Secretary of State first. You have to get that with the Secretary of State. And the reason why is because sometimes the name's not available. So you got to make sure the name is taken care of and it's available, and you get those articles of incorporation, and then, or excuse me, articles of organization is what an LLC is. And then you would go to irs.gov, and then you would apply for the federal ID number. Now, writing off your car is a business expense. The best way to handle that, and I don't talk about this a lot, so you can write off your car, like there with hands down, if you are using your vehicle, especially more than 50% for business purposes, we're going to write off your car if we're preparing your tax return. One of the steps, and another step that you can take to kind of ensure that, if you were to get audited, that we take care of, is that we have some sort of agreement in place, like a lease agreement, that you could actually lease your vehicle back to your entity. That leads me to another tax strategy, and I want to talk about this for just a second, but you can actually do something called a gift lease back. And we're gonna share this a little bit more, because it's like one of those things that I don't talk about very often, and I probably should bring it up, but it's kind of confusing, so I don't explain it a lot. But something called a gift lease back, what that means is that I could depreciate my car completely out. So let's say I bought a new Cadillac last year, and that Cadillac was over 6,000 pounds, and I was able to write off 100% of it last year. I can actually give that car to my spouse, to my children, to anyone. I could gift it to them. And when I do that, I can actually lease it back. So you have the potential to be able to write off the same vehicle. You can do it as well as with equipment, and you can actually double up on your expenses that you can write off, which is crazy. So that's also a way to income shift. Like we talk about hiring your kids, that's also considered income shifting. So you're shifting the income off of yourself and onto your children. So, and we could talk about that later. And, and I'm actually doing a video right now to kind of explain that and carry that forward. But as far as vehicle expenses, things that you can write off, if you're using your vehicle for tax purposes, it doesn't have to be over 50%, but if it's over 50%, we're typically going to depreciate it depending on the age of the vehicle and how much the vehicle cost, as opposed to writing off mileage. So you either have actual expenses, which we talk about this a lot, or you have the standard deduction. Standard deduction is just your mileage. The actual expenses, that is your repairs and maintenance, your interest on the vehicle, your property taxes, your insurance. So all of that can be written off, plus you can depreciate the car. So like even car washes and gas can be written off as well. And you can depreciate the car. So you just need to keep track of those expenses. And guys, I would suggest you use the software that you're given through our membership so that you can keep track of all these expenses. I mean, you can literally pull in your transactions, your bank accounts, your all of your transactions can be pulled in, and all you have to do is go through and say, okay, this is for auto, this is for advertising, this is for meals. So it makes it super easy for you guys to use and track all of your expenses so that you're keeping more of your money. Because if you don't track it and we don't write it off, I mean, it's costing you, for every dollar we miss out on is typically 35 cents on the dollar that you're missing out on. Okay. So what's the best way to maximize write-offs for food? So I talk about this a good bit, but there are 3 real ways to write off meals. There's one called 50% meals, there's 100% meals, and then there's per diem meals. Per diem meals are travel meals. So if you're outside of 150 miles from home, you can actually write off per diem at $55 a day. So most people don't realize that. So if you keep track of it on, it's technically a calendar, you can write off $55 a day. So most people, that is definitely going to be the best way to go, is per diem when you're outside, 150 miles from home, because most people are not going to go over $110 a day for meals. So otherwise you'd have to do 50% of your meals. The next one is the 100% meals, which a lot of people don't even realize exist. And 100% meals is things like offering your employees a lunch. So, we typically, like once a week, we will at least cater in food, or we'll go get food and we'll pay for it for our staff. And we can write off 100% of that. You can also write it off if you're, if you have an event at your home. So it can be at your home, it can be catered somewhere else. It doesn't even have to be catered. So it can be catered, or you can go buy groceries and you can buy food from a restaurant and bring it in. But in that act of doing so, you need to make sure you're either doing a presentation or some sort of training. So it's not like you just invite people over to your house and have a get together. Now that doesn't hold true for clients. So if I invited clients to come to my office and I had a party, or I had a Christmas party, things like that, either with employees or clients, that could also be 100% tax deductible. And then you could do it with potential prospects. If you had a get together, but you do need to have some sort of presentation involved. It can be short. I mean, it literally could be 5 to 10 minutes, but you've got to have some sort of presentation involved if you do it with potential prospects. Okay. And then the last one is 50% meals. So most people know about that, but anything that involves you attempting to do business building activities, meaning that you're having a conversation before, during, and after with someone that you're having a meal with, you're out of town to have a conversation with someone, even if it's not 150 miles from home, you can still write off 50% of the meal. So, if you are, here's what I think is very beneficial for people to understand. If whatever you're doing is attempting to earn an income today or in the future, and your intent of what you're doing is to attempt to earn an income, it's safe to say it's tax deductible. So when you understand that, a lot of your questions get answered along the way. Am I intending to do this to make money? Yes or no? Okay. Am I attempting to earn money today? Yes or no? And if it's yes, then it's tax deductible. If it's no, then it's not tax deductible. So I hope that makes sense. The next question is, what are the tax benefits between having a home-based business when someone is a 1099 and already has a home office? I don't really understand the question, but let's say we have a home-based business, like you've added on an additional 1099 or a network marketing business. There's not a whole lot of increase in benefits for you having a home office and then adding an additional. It's not like you can duplicate those deductions, but where it does come into play is if someone has a traditional business or they're a W-2 employee, now that they work from home, they actually can start writing off their mileage to and from wherever they're going, if it's business related, and then they can also write off a portion of their home for business purposes. So you can't increase the deduction or duplicate the deduction if you have multiple businesses. Now you could potentially break them in half if you wanted to and say this square footage is for one business and this is for the other, but it's still at the end of the day the same deductions. Now the business use of home deduction, I will tell you, is between $3,000 and $5,000 a year in tax savings. So that's or in tax deduction. So that's huge and crucial. And I want to make sure we're clear that you understand that, if you do write off business use of your home, you really do have to have some sort of location that's specifically for your home office. So it can't be like a bedroom that happens to have an office in it. It has to be an actual office. It could be half of a room that is utilized just for business purposes. That would be one way, but you do have to have something attributed just to that particular space. So it can't just be like a kitchen table that you're working on sometimes, and you're also working on it other times doing, your cooking or whatever, or you're eating. That doesn't apply. You have to actually have some sort of business space. Okay, this may be a stupid question. Can a person receive unemployment benefits even if they just started a home-based business? Yes. Even if you have started a home-based business, unemployment benefits are based upon your net income from your business. So here's what happens, guys. Like, you're building a business. And so let's say you decide to join a company today, and it may cost $500 to get started with the products. That $500 is now a tax deduction. So you're attempting to earn an income. You get to write that $500. You immediately start getting to write off your cell phone as soon as you attempt to start earning an income. So the intent of you joining the business was to make money, and now you attempt to earn an income with that. So you start sharing with people what you're doing. Now you have access to these tax benefits. You still haven't made money yet. And so what happens when you receive unemployment? Most people think, well, I'm making money over here with this company, I can't draw unemployment. Well, at the end of the day, it's all about what you bring home, what's left over after your expenses. And so if you haven't made any income yet on paper after all of your expenses, then yes, you're perfectly fine as far as unemployment. And there's typically a way that you can report that you've made some money. But remember, if you do report that, you would list whatever you made in gross minus all of your expenses, and then what would be left over. And when you're first getting started, that's typically a negative on paper. That's what people don't understand. That's why it's so beneficial to have some sort of business, guys, is because you have the advantage of all of these tax deductions that you're already spending money on. But yesterday, before you were a business owner, they were not tax deductible. So it's not like you're taking more money out of your pocket and then starting to utilize that money to build a business. You're already spending that money anyway. Now, because you are in business, you now have access to these tax benefits. So I hope that helped. My LLC is currently in health and wellness, but I'm recently gone to a travel-based network marketing company. Do I need to make a new LLC, or can we modify? What I'll tell you is that typically you base it on industry, and this entire network marketing industry is based on direct sales. So you are actually in the same industry. Like, nothing has really changed, even though you're selling health and wellness as opposed to selling travel or vice versa. You can keep the same LLC and you can continue to operate. Even if you're doing multiple network marketing companies, you can keep those all under that same LLC. So just starting out with a podcast and wanting to know if it's best to create a business structure for financial purposes. I'm a newbie and open to learning all tips. I also have a full-time position and have been working remotely since mid-March, paying for all electricity, internet, printer, supplies. Is there anything to do about that for tax deduction? I'm not getting any financial compensation for that from the company I work for. So unfortunately, as W-2 employees, there are no benefits to any unreimbursed employee business expenses. What that means is that everything you're doing from home is not tax deductible for you. If your boss reimburses you, then you wouldn't have to pay taxes on that money, but it's not a tax deduction for you. So that was taken away in the tax laws back in January 2018. So they changed the laws and they took away miscellaneous deductions, and included in that on the itemized deduction list was miscellaneous, unreimbursed miscellaneous business expenses. So that's no longer. Now, the good news is that as a financial, so you're starting the podcast, as far as the business structure, I really would suggest, especially anybody who's talking, doing a podcast, speaking online, you need some sort of LLC, because you never know, you make a wrong decision, you say something incorrectly, somebody takes it the wrong way, blah, blah, blah. I would just, for liability purposes, make sure that you have some sort of LLC in place, and you can get that really easily with your Secretary of State, and then get a federal ID number, or we can help you do it as well. So we charge $250 for that, plus the filing fee for the state, and every state is different. California charges the most. They're like $800, as opposed to, we have some states that charge like $70. So it's not very hard, but I definitely, guys, I urge you to have some sort of LLC. Now, if you just get started in network marketing, there's not a lot of liability there. If you're not planning on building a super huge business, or even attempting, you're not putting in the effort to do that, you may be okay. I know most people start off in their personal name, but I really would suggest having that LLC. It just limits your liability and allows you some tax benefits along the way if you need to take advantage of those. So just sharing that. Those are my 2 cents. You don't have to take my word for it. So the last one, I own a massage business, and if anybody has any other questions, I want to make sure that I answer those. So you're welcome to put those in the chat. But so I own a massage business. If I buy a new washer and dryer and wash the linens at my house, is the entire amount a business expense? If the entire amount is being used, or if the entire piece of equipment is being used for business purposes, yes. If it's not, then you can write off a percentage of it. If you're using it half the time for business, you would write off 50%. If you're using it 25% for business, you would write off 25%. Now, if you happen to buy that washer and dryer and you put it at your office, not saying you want to do that, then you would be able to write off 100% of that. So I hope that helps you understand, guys. Like, there's so many ways to legally, morally, and ethically keep more of your hard-earned money. I think as we continue on this journey of helping people save money in taxes and helping them understand what they can take advantage of, I think it's clear that you first have to have the intent. So whatever that happens to be. So if I intend to make money, and in doing so, I need to go to California and have a conversation with someone, my intent is to make money. And while I'm there, I need to attempt to make money. I need to actually do some actions that say that I'm attempting to make money. Along the way, if I do something else, like if I do some personal things, if I, and enjoy my time there, if I take my kids with me and spend some time with them, I can do that as long as more than 50% of my time is used on an 8-hour day, is what that means. So more than 4 hours and 1 minute a day is actually utilized for business purposes. So there's so many things that you can take advantage of along the way. I just need you guys to understand and think about taxes as if it's a game. And how do you win the game? You know the information. You have to know the rules of the game in order to win the game. And that's exactly what we're doing here. So we want to make sure that you're legally, morally, and ethically keeping as much money as you can possibly keep, because that's all that matters. It's not about how much we make. It's about how much we keep at the end of the day. And I want to make sure that you're doing that. So I hope this helps. Please, if you have more questions, please post those here. Please, we'll be posting another post in this week so that you can start giving access to any other questions that you have. I think I've answered everything today that has been asked. And just make sure, guys, I want you to get as much value out of this as you possibly can. And I know that if you're just listening and taking in the things that I'm telling you, that it's going to save you 5, 10, 15, 20,000, upwards. I think the most we've ever saved one client has been $1.8 million a year. So, I mean, this information is crucial. And as you continue to make more and more money, it becomes more and more important for you to have these tax strategies and understand them. So, if you don't already know, included in your membership is a $49 tax strategy session. You can book those. You should be able to find that access at the very top of the page. If you do not have that, please feel free to reach out to our team at info@OTB Tax, and we'll get you that link to book anytime. Those are $49. They're typically $149, and we just want to help you make sure that you are on the right path. Make sure you're tracking your deductions. Make sure you're taking advantage of the deductions that you're entitled to take. Make sure you're structured properly, and then make sure that you are compliant so that we don't have any issues along the way. So I hope you have an amazing Tuesday and that your life is more relaxing and less taxing this week.